Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance and let you know exactly what is going on right beneath the surface. And today we are diving into Prospect Capital Corporation's latest offering documents. And let me tell you, they are offering up quite a bit of debt, a lot of it. So we are going to break down what that means for Invest. Oars, and the company itself. Alright, so imagine you are looking to lend money to a big company and you want to know all the details. Prospect Capital Corporation has put out a document that is like a super detailed brochure about some new loans they want to take out. These aren't just small loans, these are notes that they're calling Prospect Capital Internotes, and they've got a few different ones coming due at different times. 549,000 point. Let's talk about the 2028 notes first. They're re-offering up almost $550,000 worth of these notes. The selling price is at par, meaning you pay exactly what it says on the tin. But here is where it gets interesting. The fees involved to sell these notes, the gross concession is about 1.125%. That means a piece of the pie goes to the sellers. The net proceeds, after all, that is around $542,000. This is a fixed rate note with a 6.250% coupon paid semi-annually. And this is unsecured, so basically it is a promise to pay not backed by specific assets. 25,000.00, then we have the 2030 notes. They're reselling about $25,000 worth. The selling price is also at par. The selling fee here is a bit higher at 1.7%. The net proceeds are around $24,575. This one pays 6.5% semi-annually, also unsecured. 25,000.00, and finally the 2032 notes, another $25,000. Selling price is at par. The concession is the highest here at 1.950%. Net proceeds are about $24,512. This note pays 6.750% semi-annually and is also unsecured. Now here is a really important point for all these notes. They recallable. This means Prospect Capital can decide to buy them back before they redue, specifically starting from the 15th of April of 2026. This is a big deal for lenders because it means they might not get their investment back on the original maturity date if interest rates fall. So the trade date for these is set for Monday, the 29th of September 2025, and they LL settle on Thursday, the 2nd of October 2025. The minimum denomination to get into this is $1,000. These notes are officially backed by an indenture, which is basically a contract between the company and the debt holders. This particular indenture has been amended several times going all the way back to 2012, and these new notes are being added by a newer supplement, dated the 2nd of October 2025. Interest starts accruing from the 2nd of October 2025. That is the official birthday of the interest payments. The interest payment dates are the 15th of April and the 15th of October each year, and the first coupon payment date is the 15th of April 2026. So who exactly is Prospect Capital Corporation? They're a financial services company focused on lending to and investing in what they call middle market privately held companies. Think of them as a financier for businesses that aren't huge publicly traded giants. They're structured as a business development company, or BDC, which has certain regulatory advantages. Now, anytime you see a financial document like this, it is going to warn you about risks, and they don't hold back. They say investing in these securities has certain risks. You should read the sections on risk factors very carefully. And when they say very carefully, it means they're probably hiding something important in there that you need to know. And here is a big one. They explicitly state that this offering, meaning selling more of these notes, will increase their total debt. They highlight that as of early 2023, they already had about $1.9 billion in unsecured senior debt and $700 million in secured debt. So we're talking about a company that is already carrying a significant load of debt. Adding more to that pile means they have to generate a lot of cash flow to keep up with all the interest payments and principal repayments. They also mention that if a credit rating agency like Standard & Poor's or Moody's decides to lower their rating, or even withdraw it entirely, that could really hurt the market value of these notes. This is a common warning, but it is important because these ratings directly influence how investors perceive the safety of their investment. Okay, this is crucial for anyone lending money. Your loan is effectively subordinated to any secured debt. What that means in simple terms is if the company goes under and has to sell assets to pay off debts, the secured lenders get paid first before anyone holding these unsecured notes. They are also structurally subordinated to any debt from their subsidiaries. So the companies that owe money to Prospect Capital often have their own debts that get paid before Prospect Capital's claims. This is a red flag. They are telling you up front that the contract, the indenture, does not offer a lot of protection for the people lending them money. They won't restrict the company from issuing more debt, paying dividends to stockholders, selling assets, or entering into transactions with affiliates. This gives Prospect Capital a lot of flexibility, but can be risky for lenders. There is also a survivor S-option clause. This is a provision where if the beneficial owner of a note dies, their representative can request the note be repaid. However, they are limiting the total amount of these repayments allowed in any given year. They can cap it to just $2 million or 2% of outstanding notes, and even limit individual requests to $250,000. So even this potential safety net has some built-in limitations. And finally, they're honest about the fact that there might not be a strong market for these notes once they're issued. They're saying assume you're holding these until they mature, because there is no guarantee they'll be easily bought or sold, or at what price. Now let S look at where their money is actually invested. Their portfolio companies list gives us a peek into their business. As of the 31st of December 2022, they had investments in 130 different companies. The total value of these investments was a massive $7.8 billion in equity and debt. One of their biggest loans is to CP Energy Services, Inc. They have a first lien term loan there that is paying a high interest rate, 12.67% linked to LIBOR, plus a significant spread. What is important here is that it is a first lien loan, meaning it is secured at the top of the repayment hierarchy. Another big one is to First Tower Finance Company LLC. This loan is paying 10% cash interest plus an additional 5% that is paid in kind, meaning it is added to the principal instead of being paid out in cash. This is often a sign of a company that might be struggling to generate enough cash to pay interest. 12.66% looking at their overall financial health. Their total annual expenses as a percentage of net assets come in at a hefty 12.66%. This includes management fees, incentive fees, interest expenses, and other operating costs. That is a significant chunk of money going out the door, just on overhead and management before they even make any profits. Prospect Capital is very upfront about the fact that they have a lot of freedom in how they use the money they raise from these offerings. They can use it for anything they deem fit for their investment objective, and they admit that investors might not agree with those choices. This lack of specific use of proceeds can be a concern for lenders and investors. Their net asset value per S-Hair as of the end of 2022 was $9.94. They caution that this value can go up or down significantly depending on the market and how their investments perform. This is vital because the value of their assets directly underpins the value of their debt and equity. Looking through their portfolio, you can see some loans are in non-accrual status, meaning the company isn't currently paying interest on them. For example, United Sporting Companies Inc. has a second lien term loan that has been in non-accrual status since April 2017. That is a long time to not be receiving payments on a loan, and it is a clear sign of trouble for that particular investment. 1,552,100,000 Prospect Capital has authorized a massive amount of common stock, 1.5 billion shares. As of early 2023, over 399 million of those shares were outstanding. This sheer volume of potential shares means there is always a risk of dilution for existing shareholders if they decide to issue more stock, especially at a discount. And to top it all off, they reserve the right to issue warrants. These are like options that give the holder the right to buy their stock in the future. This could potentially lead to even more shares being issued, further diluting existing investors. So, what is the takeaway here? Prospect Capital is a heavily leveraged company. They are actively using debt to fuel their investments. While this can magnify returns in good times, it also magnifies risk in bad times. The unsecured nature of these notes means lenders are taking on a fair amount of risk. The callable feature also gives Prospect Capital a lot of control, which is great for them but not so great for the investors who lent them the money. The fact that they have some loans in non-accrual status and some very complex financial instruments in their portfolio suggests that while they are making a lot of investments, not all of them are performing perfectly. It is a high-risk, potentially high-reward scenario, typical of business development companies, but investors need to be very aware of the leverage and the lack of protections in these debt offerings. What do you think about Prospect Capital's debt strategy? Are they playing a risky game, or do you see the potential for strong returns? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate finance. And hey, join our Discord community linked in the description to keep the conversation going. Thanks for watching. We'll see you in the next video.